Welcome to your daily 5 minutes market brief with JPMorgan and Luna. Today is August 13th, 2025. I am Luna.
I am JPMorgan.
The big headline really is that U.S. stocks just surged. Record highs yesterday, a pretty remarkable performance across the board.
Incredible. So what exactly lit the fire under this market rocket?
Well, the main driver was the July inflation data. It came in, surprisingly moderate, and that really boosted hopes that the Fed might cut rates in September. Investors saw it as giving the Fed leeway.
Leeway to cut. Okay. And here's where it gets really interesting, isn't it? The major U.S. indices. S&P 500 up over 1%, hitting 6,445. Nasdaq jumped almost 1.4% to 21,681. The Dow rose 1.1% to over 44,450. All new peaks.
Exactly. And it wasn't just the big guys. Market breadth was strong. Small caps rallied sharply, like 3%, and bank shares gained around 2.1% as well.
Right, and that bank gain, that was mostly the steepening yield curve helping them out. Yeah. Better potential margins.
Precisely. Meanwhile, gold prices, they sort of held steady near their all-time highs, around $3,350 an ounce, still benefiting from those rate cut hopes and a softer dollar.
Okay, and crypto. Big moves there, too.
Yeah, Bitcoin briefly shot past $119,000. The total crypto market cap even topped $4 trillion for a bit. But interestingly, trading volumes actually tapered off. So maybe a little bit of underlying caution despite those big price jumps.
Tapered volumes. Interesting signal. What about oil and bonds?
Oil was pretty flat, actually, near $63 a barrel. There was an unexpected build in U.S. crude inventories that held prices back. And Treasury yields, they ticked up just a bit. The 10-year yield nudged up to 4.29%.
Which sounds counterintuitive with rate cut hopes, but...
Right, but it's consistent with money rotating out of safer bonds and into riskier stocks on those easing Fed expectations.
Okay, so beneath the surface of these market highs, what are the bigger economic signals we should be watching? There was news on the U.S. fiscal deficit, right? Ballooning again.
Yeah, July's deficit was $291 billion. That's almost 20% larger than a year ago. Puts the year-to-date deficit at $1.63 trillion.
But equity investors just shrugged it off. It seems like they're laser focused on the Fed right now.
It does seem that way. It's a fascinating disconnect. We also got better news from small businesses. The NFIB Optimism Index rose to 100.3. That's its highest in 5 months.
Okay, so some confidence returning on Main Street.
Some, yes. But, and this is important, businesses also cited rising uncertainty. Worries about tariffs, inflation, geopolitical stuff, plus ongoing concerns about labor and input costs.
So recovering confidence, but still cautious. Got it.
Exactly. Caution persists.
And speaking of caution, we heard from the Fed itself, didn't we? 2 regional presidents urging a bit of patience on rate cuts.
That's right. Richmond Fed's Thomas Barkin said the current rate is maybe well-positioned. And Kansas City Fed's Jeffrey Schmid was even more direct, arguing against cutting rates too soon.
Why the hesitation from their perspective? The market seems convinced.
Well, their point is the economy still has momentum. And crucially, core inflation. The underlying trend is still, quote, stuck above the Fed's 2% goal. That's a real hurdle. So their comments add a layer of, realism, especially with the market pricing in almost 90% odds of a September cut. It's not a done deal.
Right. A reminder that it's data dependent. Okay, but there was some positive news on the trade front. U.S.-China.
Yes, bit of relief there. They agreed to extend their tariff truce by another 90 days. That avoids some potentially massive new tariffs for now and eases a bit of geopolitical risk. A temporary tailwind for markets.
Temporary being the key word, I suppose. Okay, looking ahead, what data points matter most this week?
Big ones coming up. We've got the Producer Price Index, PPI, tomorrow, Thursday. Then July retail sales on Friday. Plus the usual weekly jobless claims and industrial production numbers.
And these will be key to seeing if that dovish narrative holds up. The idea the Fed is leaning towards easing.
Absolutely. For retail sales, the market wants what you might call a Goldilocks number. Solid spending, but not so hot it sparks new inflation fears.
But what's the risk here? It feels like markets have priced in a lot of good news.
That's exactly the risk. Markets are priced pretty close to perfection on the policy front right now. Any hint the Fed might wait longer, or maybe skip September, or if PPI or retail sales come in hotter than expected, that could easily trigger a pullback.
And technically, the market looks a bit stretched. Overbought, maybe?
Yeah, the rapid run-up has left indices technically overbought. And remember those declining trading volumes we mentioned in stocks and crypto? That can suggest the rally is a bit fragile.
Like Bitcoin jumping over $122,000, then quickly falling back below $119,000 recently.
Exactly. Shows how fast sentiment can shift. Plus, you still got those background risks. The U.S. fiscal picture, the fact that trade truce is temporary, other geopolitical stuff.
So lots bubbling under the surface. What stands out most to you, our listener, in all of this?
You know, the bottom line right now is the market is clearly betting on a sweet spot. Inflation cooling, the Fed cutting rates, and growth holding steady. That's driven this broad rally.
But, as always, you really need to stay nimble. Further gains, sure, they're possible if the data plays ball, but keeping an eye on those what-if scenarios is just smart.
Couldn't agree more. Think about it. The market is pricing almost 90% odds of a rate cut next month. The biggest immediate risk is anything that seriously challenges that consensus. So, a balanced approach seems prudent. Risk management, diversification, maybe some hedges, while we wait for the next round of data and what the central banks actually do.
You've seen the headlines, but what really moves your portfolio? Money.ai scans 1.3 million signals a day, earnings, sentiment, macro shifts, and turns it into one personalized briefing focused on your holdings. No noise, no guesswork, just what matters. Money.ai, know what moves your money.